Welcome back to Investing Talk Podcast.
Today we're looking at Reddit.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So, all right, let's get into the analysis. And there's a lot to talk about with Reddit, especially around its Q3 2025 results.
Yeah.
But I think we really have to start with some of the executive share activity because it suggests the market should probably brace for a bit of volatility.
Volatility is exactly the right word. I mean, when executives start moving their own shares, every investor, takes a pause.
Of course.
We saw some pretty significant filings in November of 2025 disclosing these planned C-suite sales. We're talking about the chief technology officer, other execs, planning to sell over 97,000 shares.
Which is a lot of money.
Yeah.
About, what, $18 million in value?
Exactly, an $18 million signal.
And this isn't some sudden, out-of-the-blue move.
Yeah.
A lot of these sales, they happen under prearranged 10b5-1 trading plans.
Right, the ones they set up months in advance so it doesn't look like they're trading on inside info.
Precisely.
Yeah.
But even with that, the sheer volume and the timing of this, it definitely signals some heightened activity from insiders.
So if it's all pre-scheduled, why should we care? I mean, is this just them cashing out for a new yacht, or is it something more? Is it a real signal about the business?
Well, that's the critical distinction, isn't it?
Mm-hmm.
It requires you to watch the pattern. We saw the CTO sell about 14,000 shares 5 separate times in the months before this.
Okay.
So this new, much larger disclosure in November, it looks like a continuation, maybe even an acceleration. It might not be bearish on its own, but it does add a bit of friction to the market.
Right, which means you need context. The total number of shares out there as of November was around 137.8 million.
A little over, yeah.
So $18 million sounds huge, but you have to weigh it against that total and against whatever the big institutions are trading.
Absolutely.
Yeah.
The market has to absorb those shares, and that can create some short-term pressure. So the real question becomes, are the company's fundamentals strong enough to handle that selling? Let's look at those Q3 numbers.
Okay, yeah. The earnings announcement came out October 30th, 2025, and the numbers were strong for sure, but I thought the way they handled the announcement was, well, it was fascinating.
Oh, it was a brilliant move. Totally on brand. They're literally crowdsourcing questions for their earnings call from their own users.
From retail shareholders on the platform.
Exactly. I mean, can you think of a better way to boost transparency and just hammer home that whole community-first identity?
No, it feels authentic. It shows they're actually committed to that user base, which is, the entire foundation of their value. In a world where trust on these platforms is so low, that's a huge asset.
I agree. But authenticity doesn't pay the bills, right? Financial strength does. So let's dive into those Q3 financials because the margins are what I'd call genuinely elite.
Okay, so lay out the numbers for us.
All right. Revenue hit $549.1 million for the third quarter.
Yeah.
It's a really robust year-over-year growth, puts them ahead of a lot of their tech peers. But the headline number, one that makes institutional money really sit up and pay attention, is the gross margin.
And that was?
91.2%.
91, wow. 91.2%, that's incredible efficiency. It means for every dollar in revenue they bring in, almost all of it is gross profit before you even get to R&D and overhead.
Exactly. It is an elite-level margin for a digital platform. Now, you compare that to the EVO margin earnings before interest and taxes, which is a strong 16.9%.
Okay.
And if you look at that drop from 91% gross down to about 17% EBIT, you can see exactly where they're spending their money aggressively.
So if I'm following that, they are just incredibly good at delivering the core service, but they're sinking a massive amount of that profit right back into the company, probably R&D, right, to fuel future growth.
That is the entire investment thesis right now, in a nutshell. They are super profitable operationally, but they're choosing future dominance over showing a big net income number today. And it seems like the market is buying it.
How so?
Well, analysts are projecting, on average, something like 78.7% EPS growth for 2026.
78%. That's a huge projection. It suggests a strong belief that all this spending is about to pay off in a big way, and I guess the balance sheet gives them the runway to do it.
It does. The company is financially rock solid. They have $2.77 billion in current assets, mostly cash and investments. You put that up against their liabilities. You get a quick ratio of 11.9.
That's an incredibly strong liquidity number. It basically means they can weather almost any storm or, ramp up spending even more if they see an opportunity.
And they're funding it all themselves. Operating cash flow is $185 million in Q3 alone. They're generating cash, which is key. It means no need to dilute shareholders to fund that innovation.
Okay, so this brings us to the competitive advantage, the moat, as they say. They've got the money, but why can't a company with deep pockets like Meta or X just copy them and steal their users?
Because the whole platform is driven by these distinct, deeply rooted, sometimes weird user communities.
Yeah.
It's not built around influencers or top-down content. It's decentralized. You can't just buy that kind of scale or authenticity.
I think it's the culture of ownership. Users feel like they own their subreddits,
hmm
and the governance, even when it's messy, keeps that power decentralized. You can't fake that kind of niche content, whether it's for, finance or gaming or some obscure hobby.
And now they're using tech to make that moat even deeper. We're seeing big investments in AI-powered moderation and better engagement tools. This isn't just about policing bad content.
It's about making the platform better.
Right. It helps users find the right content, it cleans up the environment for advertisers, and it improves their returns. This tech investment is like pouring gasoline on their existing organic moat.
All right, let's pivot to the price action because the technicals, the chart itself seems to be lining up with these strong fundamentals.
The bullish trend is definitely still intact. The stock has been making a clear pattern of higher lows and higher highs. And right after that October 31st earnings report, we saw an 11.3% surge. That's a powerful reaction.
So what are the key levels people should be watching on the chart, especially with that insider selling kind of hanging out there?
The $190 to $200 range has been acting as a really firm support level. Every time it dips there, buyers step in aggressively. That tells me this is persistent institutional buying, not just quick speculation.
Okay, so that's the floor. What about the ceiling?
Immediate resistance looks to be right around the $220 mark.
And the momentum indicators, they back this up.
They do. The stock is trading consistently above both its 50-day and 200-day moving averages. That's, the textbook technical confirmation of a strong uptrend.
Okay, so here's where we shift from what we know from Q3 to what's coming. We have some fixed dates on the calendar that are pretty much guaranteed to create some movement. What should we be watching for the next 3 months?
We've got 3 huge dates. First up is December 18th, 2025. That's the major ETF quarterly rebalancing day.
Right, so that's a technical driver. Index funds are forced to buy or sell big blocks of stock just based on weighting, not on news. It's pure supply and demand.
Exactly. It's a supply shock. Next up, January 29th, 2026.
The 13F filing deadline.
That's the one. This is huge because it's our first real look at which big funds were buying or selling during that volatile fourth quarter. It tells you where the smart money was moving.
And then the big one, the real pivot point is the Q4 earnings release.
February 13th, 2026. This is the one everyone's waiting for.
Yeah.
Q4 covers the holiday season, which is critical for ad revenue. Everyone will be watching to see if that strong user engagement we saw in Q3 turned into big money during the most important part of the year for advertising.
And beyond those hard dates, there's always the market chatter, the rumors. For a company like Reddit, that can be a powerful driver on its own. What's the word on the street right now?
Well, the big one is about an accelerated rollout of their own in-house AI engine,
Yeah.
specifically for personalizing content feeds. If they nail that, it could dramatically improve the user experience, boost time spent on the platform, and make them a real threat to short-form video.
And you mentioned some whispers about partnerships.
Yep. Rumors of talks with major gaming or media companies. The idea would be to create and monetize content across platforms. A real deal there could open up brand new revenue streams outside of just advertising.
And finally, we have to talk about the elephant in the room, the big speculative rumor about a potential TikTok sale in the U.S.
Pure speculation, but the impact would be massive. Any big disruption for a major player like that would send users and ad dollars looking for a new home.
And Reddit would be perfectly positioned.
Perfectly positioned to capture a huge chunk of that market share if a competitor stumbles.
That would be a monumental catalyst. But we have to balance the discussion. What are the key risks that investors absolutely need to keep in mind here?
The number one financial risk goes right back to that aggressive spending strategy. Reddit posted a negative pre-tax margin of minus 7.6% in Q3. That's driven entirely by those massive investments in R&D and new tools.
And management's argument is that this is just a temporary, necessary phase. They're building the foundation, and the profits will come later once the new revenue streams kick in.
That's the argument. The execution risk is whether that actually happens. Will the video ads, the premium memberships, the international expansion, will they all scale up as fast as management hopes? If they spend all this money and the payoff is slow to arrive, That negative margin starts to look like a serious problem.
And of course, there are the external economic headwinds that are hitting everyone.
Correct. Broader economic uncertainty is still a threat to digital ad spending. Reddit's margins are fantastic, but they aren't totally immune. If advertisers pull back their budgets in a recession, that's going to hit their top-line growth.
So it really paints a picture of a company with this dual opportunity, right? You have the short-term catalysts like the 13F filings, but also this massive long-term growth story driven by their community and their AI investments. It's definitely not a set it and forget it kind of stock.
Not at all. You have to constantly watch the interplay between the institutions, the company spending, and the broader market. It's a structurally profitable business that's choosing to run at a loss for growth.
Which really brings us to the final, I guess, provocative question you have to ask yourself before that big Q4 report on February 13th. Is all this heavy spending a necessary investment that's going to deliver that projected 78% growth? Or is it just masking the fact that monetization isn't quite living up to the valuation? That's the line you have to watch.
And if you found this discussion valuable, make sure you subscribe to Investing Talk podcast again. That way you'll never miss our analysis on the companies and trends that are shaping the market.